Hi, I'm Kep Kepner CPA here in Dallas. You know, there's an old joke that's gone around for years about a guy that wanted to be a farmer, and he decided he was going to start out the first year really small and not buy 10 hogs because he figured he'd get a subsidy from the government for those 10 hogs. And next year he was going to grow and not buy 20 hogs, so he'd get a larger subsidy, and it goes on and on like that. So the real question is, when you own a farm, what kind of losses do you have? Because many farms throw off losses. You think about the cost of maintaining the equipment, the fencing, buying cattle or buying seed and raising and either animals or plants. So there was a case of a man in Mississippi, a lawyer, not a farmer, but he had a farm in Texas. And he would drive over to Texas several times a year, and he would work his farm, make the roads better, repair the fences, fix the barn. He did all this kind of work. And so he reported all the expenses associated with that as losses. Now, the IRS wanted those to be passive losses, because if he didn't have any passive income, he would have had to hold those losses until eventually maybe he sold the farm. So he didn't get any immediate benefit for him. But he was able to prove with his records that he worked more than 100 hours on the farm. And that was enough to prove that he was an active owner of the farm and was able to write off the losses against his law firm income. And as a matter of fact, he did not have to make up those records daily as he went along. With many records, the IRS uses the term contemporaneous, meaning that you create the records as the events are occurring. If you're wanting to prove that you drove business miles, the idea isn't for you to sit here at the end of a tax audit and go back and make up your mileage from 3 years ago. You're supposed to keep those records as you go along, contemporaneously. So he didn't even do that. He went back and said, I went to the farm on these dates, and here I bought fencing material and I worked the farm. And he was able to take all those losses as ordinary losses. Saved him a lot of money. He got to build the value as a farm. So if you're going to work a farm, if you want to be a gentleman farmer, maybe you need to be less of a gentleman and more of a farmer and go out there and really work it for at least 100 hours, and then you'll be able to take those losses. If you have any questions in this area, give us a call. We'll help you.